FMCG stocks are considered the safe, defensive corner of the market, but foreign investors have been steadily pulling money out of the sector. Over the last 12 months, foreign institutional investors or FIIs have sold around $5.25 billion worth of FMCG stocks. And here's what makes this interesting. FIIs returned to Indian equities in July, but they continued selling FMCG. So why are foreign investors avoiding the sector and what could bring them back? Let's understand in markets this week. Foreign investors have been selling Indian equities heavily since the September 2024 market peak, with cumulative outflows reaching around $57 billion. Across the broader market, however, that trend changed in July. After 4 straight months of heavy selling between March and June 2026, FIIs turned net buyers, investing around $2.5 billion in July. That was their highest monthly inflow in the past 13 months. But FMCG missed out on this renewed buying. Foreign investors have continued pulling money from the sector every month this year. According to NSDL data, they sold another 1,103 crore rupees worth of FMCG stocks in July. And that pressure is visible in several major FMCG stocks. Hindustan Unilever, ITC, Dabur and Tata Consumer have all faced significant corrections. So why are investors cautious? Traditionally, investors have been willing to pay premium valuations for FMCG companies because they offer relatively predictable earnings and stable demand. But that equation is changing. Volume growth has slowed, while input costs have increased. The West Asia conflict has added to these pressures, with costs for commodities, packaging and logistics remaining elevated. Companies have raised prices to protect their margins, but that means revenue growth is increasingly being driven by higher prices rather than consumers buying significantly more products. And there's a limit to how much of those price increases consumers can absorb. If products become too expensive, consumers could buy less, reduce consumption, or switch to cheaper alternatives. That could put further pressure on volumes. So the bigger question for investors is, how much should they pay for FMCG businesses when near-term earnings growth remains uncertain? Can FY27 turn things around? There are some encouraging signs. First quarter earnings were better than expected on both revenue and margins. But part of the margin improvement came from inventory gains. Companies benefited from inputs purchased earlier at lower prices. If crude and other input costs remain elevated, that cushion could start disappearing from the second quarter. Higher crude prices can also increase costs for packaging, transportation, and other crude-linked inputs. CRISIL expects organized FMCG companies to deliver revenue growth of around 8 to 10% in FY27, but volume growth is expected at only 2 to 3%. So what could bring FIIs back? Analysts are watching 3 things. First, consumer demand. Volume growth needs to improve from the current 2 to 3% towards mid-single digits, supported by stronger rural and urban consumption. Second, input costs. Crude oil and other key commodities need to stabilize for margins to become more predictable. And third, earnings growth. FMCG companies need to deliver profits strong enough to make their premium valuations attractive again. So the question isn't whether Indians will keep buying soaps, biscuits and toothpaste. They will. The question is whether FMCG companies can grow volumes and profits fast enough to make their valuations attractive again. If they can, foreign money could return. Until then, FIIs may continue looking elsewhere. That's it for today's episode. For more such market-related analysis, follow Business Standard.